Hello, everyone, and welcome to today's class on cash flow estimation and risk analysis. I hope all of you are doing very well. So in the last chapter, we really learned about 6 evaluation tools. And, we discussed NPVs and IRRs and MIRs and all of those wonderful tools. And we basically were using cash flows of free cash flows of various projects to evaluate them. But what we didn't really discuss was how those free cash flows are calculated. And that is actually slightly complicated. And that's why this chapter really focuses on how to estimate cash flows, and it breaks it down. And we are again specifically now talking about cash flows for capital budgeting, or and basically what that means is, for projects, and especially if you're choosing between, let's say, two mutually exclusive projects, how are you going to calculate the free cash flows? Well, this chapter is going to be discussing all of that. So, as far as capital budgeting goes, estimating cash flows is by far the most important. However, at the same time, it's also the most difficult step of capital budgeting. Definitely calculating NPVs, IRRs, paybacks, profitability index, all of those things, those are, to a certain extent, complicated, but the real difficult step is calculating free cash flows. And the reason is that when you are calculating free cash flows, number one, you need to get a lot of information from many different departments. You will be having to make some economic assumptions, and making those economic assumptions are sometimes it's very challenging to do. And you also want to make sure that there are no biases in the forecast that various departments are giving you. And so collecting all this information and making sure everything is accurate is not necessarily the easiest thing to do. There has to be a very keen focus on making sure that you are not really looking at accounting cash flows. Instead, you are looking at relevant cash flows. And by relevant cash flows, what I mean is you're looking at the incremental cash flows or the additional cash flows that will result if you take on a project. Now, there are some formulas on the slide, and we have already studied, how to calculate free cash flow. So none of this should really be, completely new to you. But there are these are just different variations. Some of this is a repeat, but I'll go through some of the key formulas for you just to refresh your memory. So free cash flows, if you want to calculate free cash flows, you have to take NOPAT, which is the earning before interest and tax, and you have to multiply it by 1 minus the tax rate. And if you add depreciation and you subtract both the net investment in operating capital and depreciation, you will get free cash flows. As far as operating cash flows, what are operating cash flows? Well, that is basically NOPAT plus depreciation. And if somebody talks to you about net investment in operating capital, well, that is the net investment in long-term fixed assets plus the investment in net operating working capital, which is basically operating assets minus operating liabilities. Another formula that can be used to calculate free cash flows is operating cash flows minus gross fixed asset expenditure minus change in operating current assets minus the change in operating current liabilities. And also, it's important to remember that when you are going to be evaluating projects, there is going to be an aspect of salvage value. And so if you are going to be calculating, let's say, the free cash flow of a project that involves, some sort of a salvage value, well, the formula for that is going to be investment outlay cash flow plus operating cash flow. So investment outlay cash flow is basically the initial investment that you have to make for the project, plus the operating cash flows, plus the and net operating working capital cash flows, plus the salvage value cash flows. And so that would give you the free cash flow. Free cash flow, there another terminology for free cash flow is also the net cash flow. And both these terminologies can be used interchangeably. Now, there are some specific issues in project analysis. And, why issues is basically, I'm talking about how to manage things, or when you're calculating free cash flows, how do you manage certain things, and how do you account for them when you are calculating free cash flow. So let's start off by talking about purchase of fixed assets and non-cash charges. So if you are, let's say for a project, you need to buy some fixed assets, how are you going to how are you going to account for that? Well, the first thing is that we know that as far as depreciation goes, when you're calculating free cash flows, you need to add back depreciation to the NOPAT. And also one thing that you have to take into account for is that depreciation basically shelters income from taxation. So you need to add back depreciation tax savings to your when you're calculating your free cash flows. And what that is basically the depreciation multiplied by the tax rate. And you have to add this back to your free cash flows when you're calculating your, when you're trying to find out your free cash flows. Okay, some other interesting things, regarding net operating working capital. So what happens many times is when you're taking on a project is that you really many times need additional inventory at the beginning of the operation. And this usually reduces your cash flow. So you generally have to take that into account. One thing to mention, however, is that at the end of the project, this is reversed and that additional inventory is released, and in return, money is received. And so you either get cash is received. So therefore your cash flows will increase. So again, for additional inventory, many times cash flows decrease and right at the inception or beginning of the project, but then at the end of the project, this inventory amount, cash that was tied into inventory is received back. One thing to also mention is that interest expenses are not included in project cash flow. So this is something that you do not need to worry about when you're looking at project cash flows. And next, I'm going to talk to you about something known as sunk cost. And sunk cost is basically some cash that you had to, invest in. And this has happened in the past. So it was a cash outlay that has occurred, and it really doesn't affect the project that you are looking at and you're considering whether to take on or not. So such costs should just be ignored in capital budgeting. Let's say, for example, there you have a project and there is a piece of land that it has nothing to do with the project. You're not going to use it in the project, but it was just some piece of land that you bought many years ago. Should you include it in the project analysis? Absolutely not, because that is a sunk cost. That is something you bought for some separate reason, and it has nothing to do with the project that is being considered. So again, such sunk costs should be ignored in capital budgeting, and the focus should be on future incremental cash flows of projects and the net present value of projects' incremental investment. So basically, any cash flows related to the project, any money that's going to be generated or money that's going to be going out specifically for the project, only those things should really be focused on. Next, I'm going to talk to you a little bit about opportunity cost. And this is something that comes up in finance many times. And opportunity cost is basically cash flows that could have been generated from an asset that the firm already owns, if not used in the project in question. So for example, let's say you own an equipment or building and you're using it for for a project that you're considering, then you should consider the equipment or building costs, because if you were to sell it in the market, you could get that much money that you were foregoing as an opportunity cost. So basically, if you had, let's say, bought a piece of land and you are going to be using it for the project, then you have to include that in when you're making the analysis of that project, because A, you're using it for the project. B, if you were not using it for the project, you could have maybe sold that land and got certain amount of money, so that you are foregoing not selling the land, foregoing that money because you're using that land for this project. That's why you definitely need to include it when you are making calculations for this particular project. Also, I'm going to talk to you about something known as externalities, and this is basically effects on other parts of the firm. So sometimes what happens is there's something known as a cannibalization effect, and this happens because, let's say, there's a new business that a company is launching, and let's say it's a new product that the company is launching. Let's say you have 6 chips, potato chips brands, and you are launching a 7th brand. And when you launch the 7th brand, then actually people start having less of your own other brands, and they start having the 7th brand. Well, in that case, what's happening is the new business is eating into your existing business. And that's why this is known as the cannibalization effect. Now, the example I gave is an example of a negative externality, but sometimes there's also something known as a positive externality. And so maybe, you're doing something and that has a positive effect on all your other businesses. And that is an example of a positive externality. Okay, also, I want to talk to you a little bit about replacement projects. And replacement projects occur when a firm replaces an existing asset with a new one. And usually in replacement projects, companies compare getting the replacement to continuing with the old. So generally speaking, if you're thinking that, say, there is, I don't know, a big, part of your factory that you're thinking of completely replacing and renewing it with new, factory machinery. Well, there are 2 options. If you replace it, then that's one option. And if you continue with the old, that's the other option. So that's basically, you're looking at a replacement project, and you're really looking at what would happen if you replace it versus if you continued with the old. One thing also to mention is, I think I've already mentioned this in the past several times, but I'm mentioning it again, is that in general, cash flows, when you're calculating cash flows, especially for capital budgeting, it is assumed that all the cash flows are going to be received at the end of the project, at the end of the period. Okay, so at the end of every period, cash flows are going to be coming in. So again, it's not the timing of the cash flows. I meant at the end of every period. Okay, not in the middle. So it's not like you'll be getting cash flows in the middle of the year. You will always be getting cash flows, let's say, at the end of every period, which is usually 1 year. Okay, so next I want to talk to you about depreciation. Now, you all are familiar with depreciation. You've heard of straight line depreciation, accelerated depreciation. Another type of depreciation is also known as modified accelerated cost recovery system, or MACRS. And in some of the questions in the book, they expect you to use the MACRS to make the calculations for the free cash flow. And if you are expected to use the MACRS, well, you will also be given a depreciation schedule. And I've just added it over here for your convenience. But if it's the question says it's a 3-year depreciation, well, you'll know that these are the rates of depreciation for each of the 3 years. So 5 years, these are the rates, 7 years and 10 years. So these are just some, a different type of depreciation that you should be familiar with. And on this slide, I kind of just wanted to show you an example of, how cash flows are being calculated. And you can see right over here. And again, this should be pretty familiar to you, but you start off with your sales and, all of your costs then, right? So here you see the units and then the unit price. And then you see the cost, variable cost per unit, the non-variable costs, and here they've basically just calculated unit sales into unit price, that's 15,000. And, and then basically there's some information additional of all of the depreciation expenses. So these are just right in the blue it's sort of just the basic information that is given to you. Here now in this section, they start showing you calculations of the free cash flow. So starting off with your sales, then the variable cost, then the fixed or non-variable cost, and then the depreciation. So, you take the sales revenue, you subtract all of these expenses, and that will give you 403. And then you take out the tax amount, and that will give you your non-operating profit after tax, or the NOPAT. And after that, the first thing you do is you add back depreciation. In this particular case, it seems that some equipment is being bought at the beginning for this project. So that's being taken account of over here. And it also seems that at the end of the project, the equipment is being sold for a salvage value. If there are some tax savings on the salvage value, that's over here, here. Cash flow due to change in working capital, that's being accounted over here. And then a summation is taken, and these are the cash flows. And then the various, 6 methods or tools of evaluation of the project are being applied to really figure out whether or not this project should be taken. And from here, just the looks of it, it looks that the project should be taken. These results seem quite encouraging. Now, one thing I also wanted to mention is that it's important to adjust for inflation. And there's certain things that I just want to mention some terminology as far as inflation is as far as inflation goes. Number one, interest rates in the absence of inflation. If there is absolutely no inflation, then an interest rate is known as the real rate. And if there is some inflation involved, then interest rates are known as nominal rates. Okay. And the nominal net cash flow, if you want to calculate the nominal net cash flow, well, what you have to take is the real cash flow and you multiply it with the inflation rate, right? And that will give you the nominal net cash flow. Also, these are just some important formulas for you to know. 1 plus the nominal interest rate is basically equal to 1 plus the real interest rate times 1 plus inflation. So obviously you're taking your real interest rate and you're accounting for the inflation rate. And as far as NPV goes with inflation, this is the real, in order to calculate the NPV with inflation, you take the summation of the real cash flow and you divide it by 1 plus the real rate of return. And, it depends how many years. So T is going to be the number of years. So these are just some important formulas for you to know. If the cost of capital includes inflation premium, as it typically does, but the cash flows are stated in an unadjusted dollars, then the calculated NPV will be lower than the true NPV, right? So it's very important that, that you account for inflation, and the way that you can account for inflation are 2 ways. Okay, the first way is that you can adjust the cost of capital by removing the inflation premium. Now, either you can adjust the cost of capital, or you can actually adjust the actual cash flows. Now, generally speaking, people do not adjust the cost of capital by removing the inflation premium, because This is a little complicated. It requires that all project cash flows, including, there's certain assumptions, right? And so those assumptions, they're given over here. I don't want to go into too much detail about them, but the important thing is for you to just remember that generally speaking, people adjust cash flows to reflect inflation and they leave the cost of capital as it is. Also, it's important to mention that, look, it's very hard to forecast inflation, but at the same time, it's an important factor that should be considered because inflation really changes the value of goods and it changes the cash flows in the future. So it is something that needs to be taken into account. Now I'm going to talk to you a little bit about risk analysis. As far as risk analysis goes, and when we're especially looking at projects, there are three kinds of risks. The first one is standalone risk. And this is the risk that a company would have if the company had only one project, the project that you're, let's say, considering. It is caused by variability in the project's cash flows and usually is measured by standard deviation of the project's NPV. So again, if the question requires you to really measure the standalone risk, you will be focusing on just the one project that you are considering, and you will be measuring it by calculating the standard deviation of the project's NPV. And next is corporate risk. And this is, also called within firm risk. And here you're really looking at, look, if you take on this project, how is it really going to contribute to the corporation's stock returns? Considering that this is just one of many projects the company is taking on. So some of the risk can be eliminated by diversification if it's not perfectly, correlated with other projects. So again, standalone risk, can't really be diversified away, but some of corporate risk actually can. And then there's market risk, and this is the risk due to a project's effect on the beta coefficient. And this is risk that cannot be diversified away. And we've discussed market risk before as well. Okay, moving on. The next thing I'm going to talk to you a little bit about is sensitivity analysis. And this is also very important because this really indicates, it creates various scenarios and it sort of talks to you a little bit about, look, okay, you have created one scenario, you've made a forecast of cash flows and you have calculated the NPV based on that. But the thing is, how do you know that those cash flows are necessarily going to be absolutely correct? Because they're based on assumptions. So many times what companies do is they create a base case. So they make certain forecasts and then they make, a best case and a worst case scenario. And they ask a lot of what if questions, like what if something bad happens? That would be like a worst case scenario. What is the lowest that, what is the highest, for example, in the worst case scenario, what is the highest inflation rate that could really impact the company? How low can sales go? Things like that. So you're asking what if questions and you're creating a scenario, a worst case scenario. And then they also create best case scenarios. And, they sometimes, there's a famous simulation known as the Monte Carlo simulation. And this basically ties together, the sensitivity. It does a lot of sensitivity analysis and it also includes probabilities. And what happens in Monte Carlo simulation is that companies pick variables at random and calculate NPVs. And so there are like thousands of scenarios. And based on those thousands of scenarios, NPVs are calculated for each of those scenarios. And then standard deviations and coefficient of variation are calculated. In certain situations, you will be asked to calculate, the standalone risk. And I just kind of mentioned, standalone risk, you have to sort of calculate the standard deviation. And so the standard deviation of NPV, you have to sort of calculate it using this formula right over here. And here you can see, the breakdown of, first of all, you have to calculate the expected NPV. And so probabilities are going to be given to you of various NPVs, and then you have to sort of take a weighted average. And so you basically, when you're calculating the standard deviation, you take the actual NPV that has been forecasted, multiply it with the probability, subtracted by the expected NPV, take the summation of this and you square it. And so you basically do this for all of them. And that's how you calculate the standard deviation. And as far as the coefficient of variation for NPV, that is basically the standard deviation of NPV divided by the expected NPV, which you just calculated over here. And that is what the coefficient of variation, that is how that is calculated. So again, all of these are basically just to sort of check the amount of risk associated with various NPVs. And that is why these are being calculated. The next thing that I'm going to talk to you a little bit about is managing risk through phase decision trees. And what decision trees look like is something right just like this. And generally speaking, look, managers are interested in reducing risk as compared to measuring it. So, all managers want to reduce risk, and decision trees basically allow managers to reevaluate decisions using new information, and then they can decide whether they want to invest in additional funds or terminate the project. And so over here, you can see that there's some circles, right? And then there's also, each of these circles is known as a decision node. And each of the diagonal lines, here's a diagonal line over here. These are all branches. And the branches of the tree, they basically show the probability, estimated probability. And so here I'm just going to really sort of talk to you a little bit about how this decision tree is made and how it works. And so here, in investment, you can see it's a negative cash flow. Oops, so the negative cash flow is being made of 500. And if the result is negative, there's a 20% result that there's going to be the investment results are going to be negative. Well, then you just drop the project right over here, you stop it. There's the 80% probability, however, that the project, you decide that you make another, you have to make another investment. So in year 0, you made a negative 500, then you make another $1,000 investment. And then there's a probability of 40% that you just decide to stop the project, but a probability of 60% that you decide to make yet another investment of $10,000 in year 2. Now, after you make all these investments in year 3, there are 3 scenarios that are given. The first one is that, there's a negative 2,000 outflow. And so in that case, you may want to just decide to stop the project. And then there are 2 other probabilities. There's a 30% probability that there's going to be a cash flow of 18,000 and a 40% probability that there's going to be a cash flow of 8,000. And if in both of these scenarios, those cash flows will continue for year 4 and 5. And so basically the joint probability over here of 0.144 is when you take 0.8 multiplied by 0.6 multiplied by 0.3, that will give you this. And the 0.192 is 0.8 multiplied by 0.4 and multiplied by 0.4. So basically you're taking all the joint probabilities, and that is what gives you these numbers over here. All right, and then you basically calculate the NPVs. And what NPVs are we talking about? Well, each of these is a cash flow, right? And so you basically calculate the cash flows based on the cost of capital. And then at the end, you sort of multiply each of these expected NPVs by the probability, right? These joint probabilities, and that will give you the expected NPV of this project. And, you can really decide whether or not you want to do it. So this is just another way of really breaking down things and looking at all the different scenarios of all the things that could happen, the good, the bad. It's here you can see a worst case scenario, best case scenario, and sort of base case scenario has been drawn out, and probabilities have been assigned in each of those cases. And it's just a more, and just for your reference, I've given the details of this is right from your book. but I've also just given all the details, and it explains exactly what I just explained to you. But this is just another way of breaking things down and really trying to create a very realistic idea of what the NPV will be, what the expected NPV will be. Because again, it's not favorable to come up with necessarily a, very rosy picture, and neither is it beneficial to come up with a very gloomy picture. In fact, it's best to come up with a realistic picture. And when you use tools like a decision tree, that really help you come up with a more realistic expected value of net present value. And with that, I come to the end of this chapter. This chapter has some complicated problems as well. I will make sure to go through those problems with you in class. But I do suggest that you spend some extra time solving the problems in this chapter using all the information that has just been discussed in this lecture. And I look forward to discussing with you more in our class. Thank you very much and take good care.